The benchmark Kospi index has been noting an impressive run in recent months, and on Press Perspective today, we touch upon the reasons behind the rally and the prospects ahead. Hello and welcome to Press Perspective. It's Thursday, November 13th here in Seoul. I'm Min Sunhee. Now today we touch upon the local stock market rally and the state of the Korean economy. For more on this, I have Lee Ji-hoon with Reuters here in the studio. Ji-hoon, it's been a while. Welcome back.
Good evening. Thank you for having me.
I also have Professor Kim Young-Jin at Sogang University live on the line. Professor Kim, as always, it's a pleasure to have you with us.
Good afternoon. Happy to be here.
Right. Ji-hoon, we'll start here in the studio. Let's begin with some background information about the South Korean stock market's performance this year.
Yep, Kospi has been the world's best performer so far this year, rising more than 70%, which is already the biggest increase since 1999. Just for some global comparison, in the United States, the S&P 500 has risen 15%, Nasdaq has risen 20%, and Japan's Nikkei has risen 30%. This year's Kospi rally was accelerated after President Lee Jae-myung won the election in June because he has put various market reforms under his so-called Kospi 5000 initiative. Several measures have already been introduced, including the revision of the Commercial Act to better protect minority shareholder interests, as well as measures to encourage more share buybacks and higher dividend payouts, and tax incentives for stock investors. When you think about it, the Kospi was trading around the mid-2000 range before President Lee won the election in June. But now the Kospi is trading above 4,000, hitting its highest level on record. Other than market reforms, the rally has also been driven by AI optimism, boosting heavyweight semiconductor stocks. Samsung Electronics, for example, has risen more than 90% so far this year, which will be the biggest rise since 1999. And SK Hynix has risen more than 250%, its biggest ever. Last month, when South Korea hosted the APEC summit in Gyeongju, there were trade deals between South Korea and the United States, as well as between the United States and China, which also reduced some uncertainty for stock markets. But then last week, there were some concerns raised among investors that there might be a bubble in the AI sector that triggered higher market volatility as well as sharp losses in Kospi and across global financial markets. This week, however, Kospi rebounded again to trade above 4,100, which is just below the 4,200 hit earlier this month because investor sentiment recovered this week.
Right. Now, given the strong rally in the local stock market, Professor Kim, some pundits have raised concerns about the pace of that rally. Do you believe the pace is a cause for concern?
Well, the Ji-hoon well explained, it's a kind of historic moment, right? So the rise of the Kospi and Kosdaq indices are amazing to me, to every investors in Korea. The Kospi index was introduced in 1983 with a base value of 100 as of January 4th, 1980. Now it is 4,100 point. In 45 years, it grew 40 times, right? Amazing. Now, narrowing the time span to this year, like, Ji-hoon explained, it started at 2,360. And in April, where we had Donald Trump, President Donald Trump's, reciprocal tariff and martial law declaration, I was about 2,280. And, June 4th, Lee Jae-myung's inauguration, It was 2,770. Now it is 4,170. It's a quite dramatic, change. So it looks fantastic, but like we mentioned, the pace of the rally has attracted some concerns, among investors. According to Bloomberg, the Kospi volatility index, which is called the V Kospi, jumped to the level seen in April. So a bad time, right? Now, when the U.S. President Donald Trump announced reciprocal tax, and the ex-president Yoon declared martial law, so the market plunged. However, to me, it looks like just in the process of normalization. Think about the past values. The PBR, the price book value, was under 1, which means the stock price of Korean companies were lower than their real value. So I don't worry about it much at the moment, even though there are some concerns of the speed of the increase of market values.
Right. Professor Kim, amid news of the historic highs hit by the benchmark Kospi index, the fear of missing out appears to be driving quite a number of individual investors into the local stock market. What are your thoughts with regard to this particular trend?
Well, a lot of Korean investors went to the U.S. stock market, right? So now coming back. So, probably every investor may hear that, when the stock price goes up, may know that, right? Recently, when stock price goes up, investors buy more, while, when the price goes down, they sell more. It is totally an opposite behavior which means, make money, right? If you want to make money, you need to buy when it goes down, and you sell it when it goes up. So now people, show the weird behavior. However, I think, it is quite natural behavior, considering you mentioned in the former, right, the fear of missing out phenomenon. It is inevitable for individuals, to join the group behavior when they, hear other investors make a lot of money in the market. The truth is that even in the bullish market, there are many investors who lose money. We have to keep in mind, right? So my 2-cent advice is that when it is too hot, just keep a step away and cool down yourself. Then you will see what's going on out there, and then more clearly. My final word of advice are, picking solid and good companies to invest and stay with those stocks for a while.
Right, so keep your investment long term then. All right, Ji-hoon, let's now turn to the latest projections with regard to economic growth, Ji-hoon. The KDI earlier this week shared its growth forecast for the South Korean economy next year. Could you tell us a bit more about that?
Yep, KDI, or the Korea Development Institute, is a state-run think tank conducting research for the government. Its views are often considered to reflect the views of the government as well. This week, and the think tank KDI raised South Korea's economic growth forecast to 0.9% for this year from 0.8%, and next year's to 1.8% from 1.6% seen in August. It said economic sluggishness is easing, led by private consumption, thanks to lower interest rates as well as expansionary fiscal policy. And as you're aware, South Korea's economy grew 1.2% in the last quarter, which was above market expectations and the fastest is in 1.5 years. During the third quarter, exports remained robust thanks to strong demand for technology exports, and consumer spending also rebounded on the government's cash handout scheme. Next year, KDI said domestic demand will further improve because the government plans to raise its budget spending at the steepest pace in 4 years, although exports are expected to weaken due to U.S. tariffs. And along with those economic forecasts, KDI also provided some policy recommendations, which market participants said was a little bit hawkish. It said there was no huge need anymore to lower interest rates more because domestic demand is already improving. It also said fiscal policy will need to normalize after next year to control sharp rises in government debt. When it comes to risk factors, KDI said there still is uncertainty over the recently signed U.S. trade deal because details of the agreement will have an impact on South Korea's exports.
Right, and speaking about the risks to South Korea's economic growth for next year, Professor Kim, if I were to ask you to highlight 3 potential risk factors, what would you choose to highlight?
It should be 3. Okay.
One then?
I echo to what you mentioned. I suppose that the 3 main risks to South Korea's economic expansion next year are including global trade uncertainty and protectionism and high levels of household debt and national debt, just like this year. And one thing, long-term demographic challenges. The Korean economy is highly dependent on exports, so it is vulnerable to external shocks and the global trade environment. Escalating trade conflict between, especially the U.S. and China, the U.S. and Korea trade deal might be done, so it will be eased, but still there are some tensions between U.S. and China may pose a significant risk. Moreover, slow global economic growth, which is influenced by the factors such as high interest rate in major economies and weakened fiscal capacity in key nations, could reduce demand for South Korea's goods. And secondly, domestic vulnerability, like I mentioned, that high debt levels of household, right, are a major concern for the sustainability of economic expansion. Elevated household debt would be likely weigh on the private consumption and investment, even though it is, getting better. In addition, Korean government, debt, which is projected to climb, reaching 58% of GDP in 2026, may negatively affect, both long-term fiscal sustainability and even foreign exchange rate. Finally, it is kind of structural issues like, rapid aging of population and a world lowest fertility rate, threatening long-term economic vitality. So a declining labor supply puts pressure on economic growth and growth and productivity, and the rising dependency on social welfare spending increases the burden on the social welfare system and public finances, requiring different structural and fiscal reforms to manage future age-related spending pressures.
Right, which is something the President touched upon today as well. Ji-hoon, this is in relation to what the KDI spoke about earlier this week with regard to potential rate cuts. The Bank of Korea also has expressed some caution about future rate cuts given the current state of the local economy. Could you tell us more about that particular caution and its broader implications?
Yeah, this week the Bank of Korea also released minutes of its last monetary policy meeting in October, when the central bank held interest rates steady for the 3rd straight meeting after the last cut in May. Most board members still agree monetary policy needs to be accommodative because economic growth is still below its potential growth rate. However, policymakers are concerned about financial stability risks, particularly sharply rising housing prices and especially foreign exchange rates. One board member said, for example, the board should consider not only the benefits of rate cuts anymore, but also the side effects of rate cuts for future monetary policy operations. Another member said more emphasis is required on foreign exchange rates because recent weakness in the won is mostly due to domestic factors, not external ones. And even board member Min Sunhee, he is known to be a dovish member, and he argued for a rate cut last month, but he also acknowledged that monetary policy has been complicated by those financial risk factors. Even more, yesterday there was another hawkish comment from Bank of Korea Governor Lee Chang-yong during his interview with Bloomberg. He said monetary policy will continue to depend on data, but not just its degree or pace, but also the direction of monetary policy itself. That raised worries among market participants that the Bank of Korea will even consider raising interest rates, not lowering them. And that triggered a rot in bond market as well, with Treasury bond yields rising sharply yesterday to the highest level since late last year. Recent data also support these concerns because household debt growth rebounded in October, data showed today, after a slowdown in September on the government's efforts to stabilize the housing market. More concerning is the won because it is weakening sharply these days due to the uncertainty over U.S. trade deals. And just today, the dollar-won exchange rate rose above 1450, which is the highest since April 9. So because all of these financial risk factors, many analysts expect the Bank of Korea to hold interest rates again this month when the central bank holds its last monetary policy meeting for this year.
Right, 1,450 per greenback, right? Back in April, I believe it was 1,487 won per greenback, right? Ji-hoon, beyond the domestic economy, analysts also believe that the global economy will expand 3% next year. Again, to give us some details, and what are the variables with regard to this particular outlook?
So KIEP is another think tank that is run by the government and conducts research for the government. KIEP, or the Korea Institute for International Economic Policy, this week raised its global economic growth forecast to 3.0% from 2.9%, saying the negative impact of U.S. tariffs has been less than previously feared. Among major countries, KIEP raised its forecast for the United States to 1.8% for next year from 1.3%, and China sharply to 4.8% from 4.1%. Everyone knows they are the two biggest economies in the world, and they have been in a trade truce for some months now after earlier tariff war triggered by President Donald Trump's tariff policies. And recently, they reached a trade deal at the APEC summit in South Korea that also reduced uncertainty over not just for the two economies, but for the global economy as well. KIEP's forecast upgrade this week is in line with other international organizations, such as IMF, which expects the global economy to grow 3.2% this year before growing 3.1% next year. IMF said last month the global economy is doing better than feared, withstanding U.S. tariff impact. But although it also said there were downside risks, they were still dominating its growth forecasts. KIEP also said there were downside risks to its growth forecasts, especially around the global trade order. Among those risk factors, KIEP said it is necessary to closely watch how the trade conflict between China and the United States developed after the two countries reached a trade deal earlier this month.
Right. And Professor Kim, speaking as a scholar at a prestigious university here in South Korea, what is your outlook for the global economy next year?
Well, Ji-hoon already explained all of the things, but, to me, the outlook, for the global economy in 2026 would be really kind of mixed. The growth rate might be about 3%, like IMF and OECD expected, which is kind of modest. right? The persistent risk like geopolitical tensions, policy uncertainties, and trade barriers may negatively affect the global economy. While inflation is expected to fall globally, some regions may see resurgence like the U.S. and Japan. And the U.S. economy's growth is projected to slow significantly compared to 2024, like Jill mentioned. The major source of uncertainty will be higher tariff, which will negatively impact growth and also push inflation up in some economies, including the U.S., EU, and Korea. Geopolitical tensions still remains a significant downside risk to the global economy. Meanwhile, the rapid advancement of artificial intelligence offers potential for lifting a medium-term economic prospect, right? And fiscal expansions, in major economies, including Korea, is expected to support the growth. So, in sum, the global economy in 2026 may have some positive factors, but a little bit more negative factors.
Right, I see. Well, on that note, we're going to end this discussion. Professor Kim, as always, thank you very much for your time and your thoughts.
My pleasure. Thanks for having me.
Right, and Ji-hoon, thank you very much for your insights today.
Thank you very much.
Right, that ends this edition of Press Perspective. As always, thank you for watching.